Welcome back to Growth TV, an ACG production. I'm Carolyn Vallejo. Dealmaking didn't kick off 2025 quite as active as many had hoped, with plenty of factors suppressing M&A activity. Back to offer some clarity into how Q1 panned out and why are Scott Linch, managing partner of Forvis Mazars Capital Advisors, and Bob Dunn, managing director of GF Data. Scott and Bob, as always, welcome back.
Thanks for having us, Carolyn.
Thank you, Carol.
Now, dealmakers had pretty high expectations for the start of the year, but as I mentioned, things didn't exactly pan out like everyone had wanted. What does the data reveal? Bob, let's start with you.
Yeah, I think the data is a reflection of a lot of uncertainty that was happening in the first quarter. I think the time before last when Scott and I got together, we're perpetual optimists on the market, I think, but we were expecting a strong first quarter. Fourth quarter had been a little bit muted, but still good deal flow. And then when all was said and done, we were about 40% off of where we were in the fourth quarter for completed deals. We only tracked 59 completed transactions, which is definitely a low tally for the first quarter. And again, I think because we track completed deals, you saw questions about what was going to happen with the new administration, questions about economic policy, and I think a lot of tapping of the brakes on the part of folks with deals in process going on to kind of delay that, wait it out, and see what actually happens with some of the policy that's being discussed.
Yeah, I would just say we keep thinking it's going to calm down and things will be normal, but we keep having a lot of uncertainty. And we talk about tariffs, interest rates, immigration. Now we got geopolitical things going on. Or the Iran situation is not gonna help make the uncertainty better. And so we just see deals slowing or deals waiting to go to market as a result of some of the uncertainty, with interest rates still not going down. In other countries, they have gone down, so we would expect eventually it'll happen here too, and that should help. Got a lot of pent-up money ready to go to work for sure.
And there's demand out there as well, right? I mean, we do have, and we've talked about this before, this whole generation of small business owners, independent business owners that are looking to exit, but it's been one issue after another that seems to have delayed them. But I do think the demand is there. It's just a matter of what will unlock that.
The demand is definitely there. I mean, private equity funds are looking to put money to work, and we're going to talk about this later. But that's why when you see deals get done, they're pretty good deals.
Right. No, kind of continuing on that thought, purchase price multiples are up, actually. So what's kind of going on there?
Yeah, we saw a huge uptick in the first quarter in some areas, particularly business services. Two factors driving it, and one reflection of what's going on out there in challenging times. You're going to have a flight to quality, and I think that's what we're seeing here. We have a metric we look at for above average financial performing companies, which we define as companies with greater than 10% trailing 12-month EBITDA margin and 10% trailing 12-month revenue growth. That had sort of started to drop compared to historical levels last year. And then in the first quarter, we saw that pick up, still below historical levels, but go up to 49%, where it was hovering around 40% last year. So there's definitely a movement toward the higher performing companies in times of uncertainty. The downside of it is that the multiples being paid on that are a bit constricted. And then the other factor going on in the market that's driving up average pricing is a focus on add-on investing, which is happening now. And I think the factors on that, one part, when debt was tough to come by, like debt markets were challenged, add-ons were a good option to deploy some capital and grow the businesses without having to go into new financing arrangements. And then also, if you look at the crop of companies that are owned by private equity now and that are looking to be exited, a lot of them were bought in 2021 when we saw peak multiples there as well. That add-on activity, I think, is also an attempt to kind of add value to the companies, build them up a bit, and even if multiples are depressed, still get a good return on the investment from when they invested earlier on.
Yeah, I mean, good assets still get good valuations, and so that's what we're seeing as there's limited deals in the market right now because of the uncertainty that we talked about, but those that are getting done are good deals, and they're highly competitive. As we mentioned earlier, private equity funds are searching all over for deals to do that could be, add-ons or a heavier piece of that, but they're looking to do those deals, and it turns out to be, a better asset probably that's getting done right now in this uncertain market. So therefore, the multiple on that's going to be high because there's going to be a high level of competition for those deals.
Mm-hmm. Now, you two are not the only optimists in this space, of course, because deal makers are very resilient. They're always pushing for deals to make it across the finish line. And I know you kind of mentioned this earlier, but tell me a little bit more about how these smaller add-ons are helping to keep deal volume up.
Private companies are going to go to market whenever they are ready to go to market. So a founder is going to sell his business when it's right for them in their time of life. And so they're not as worried about the macro trends that might be happening out here. Some of the things that we're talking about, they're ready to go to market. So I do think that's helping the add-on activity. A lot of those deals end up being smaller sometimes. And so a nice number of those types of deals in the market, in the lower middle market, we're still seeing that activity get through some of this uncertainty. And there's a lot of areas where people are just doing a ton of add-on works right now. It's if you think about business, if we talked about consumer and business services earlier, I mean that portion of the market is still very hot. Residential services remains very hot, but the commercial services are equally as hot, I think, as far as deals that are getting done. And those are the ones where they're very fragmented market, in the market. So we're looking to do a ton of add-ons to bring those businesses together and create a bigger platform. And so that is what we're seeing. And what we're seeing, what Bob talked about, is they pay a high multiple sometimes for the platform, but now they got to do add-ons at a lower multiple to make it really work. We're also seeing, markets around infrastructure and businesses that make stuff in America are also becoming a pretty attractive market to kind of build up those businesses. So I continue to think we'll see the add-on game being played. Those are deals that are easier to get done right now, but the platform deals do have to come back at some point. And, we do remain optimistic that that'll happen here at some point in the near future, whether it's end of this year or the beginning of next. I still think the end of this year, we're going to see some of those in the market. Whether they get done by the end of the year, I'm not sure, but they'll definitely be hitting the market towards the end of the year.
Yeah, I would agree with you, Scott. I think, anecdotally talking to people, everyone's busy out there. There's a lot of deals being looked at. I think there's a lot of deals that are in process, but I think it's a question of how long that diligence period goes and what happens in between. Hopefully nothing. Hopefully things smooth out a bit. But I'll continue to be an optimist with Scott on this. I think at least by end of year, we'll be seeing a better marketplace, hopefully sooner than that.
Excellent. Well, Bob and Scott, as always, thank you so much for joining us, and we will check back in next quarter.
Always a pleasure. Thanks, Carly.
Appreciate it.